Welcome back, everyone, to Cheddar Movers. The coronavirus continues to spook investors as it continues to spread to new regions. Stocks, though, are actually on the rise here on this Wednesday, despite Brazil confirming its first case and Italy's cases tripling over the past 2 days, which we've seen steep declines across the markets. Cayman Wills is the global head of equities at JPMorgan Private Bank. Great to have you with us.
Thank you. Thank you for having me, Hope.
Let's try to make sense of this. We have, on the one hand, a top CDC official warning Americans should be prepared for the virus to spread. And then we've got these new cases now that outnumber the ones in China, yet markets today breaking the trend that we've seen the last 2 days. What do you think is going on?
Yeah, so let me just start with how I'm framing the conversation with my clients. What long-term equity investors need to remember is that pullbacks are normal. In fact, we tend to see 3 to 4, 5% pullbacks every single year. And in fact, the average pullback is about 14%. So for those long-term investors, what you got to remember is that 77% of the time, even when you have these big pullbacks, you tend to see markets higher within that same year. So when you're absorbing all these new news, you got to say to yourself, what is the impact of this news on the fundamental story? So here comes the news, obviously coronavirus. The outstanding question here is the new cases that we're seeing outside of China. And the longer that this goes, the more and more uncertainty there is around supply chains, consumer demand, and eventually GDP growth and earnings. Our base case right now is that we will receive a rebound in manufacturing activity as this subsides. Now, will it be a V shape or a U shape? No one really knows, and no one really knows when this is going to happen. However, this is what we've observed in other historical instances like SARS or in the Fukushima outbreak in 2011. And so we remain positive on equities here, being thoughtful about our exposures. But again, remembering the fundamentals of what brought us into a really strong 2020 to start. And what that was low interest rates globally. That's very supportive to manufacturing activity, demand, as well as a really strong consumer. 70% of our GDP that remains supported by both a strong strong unemployment economy and also those lower interest rates.
Right, and that's great context. And for those that don't have the historical context of the markets, in the same way that you do, why does it feel so scary, in the moments when we see these numbers decline so rapidly intraday because of these headlines?
And these multiple down days tend to be abnormal. So yesterday, I think a lot of people were hoping that we'd start to see that market recovery. It didn't happen yesterday, and especially with those new CDC warnings that you mentioned. So today we are getting that rebound, and what's important to remember is that markets are never going to wait for the all clear signal to then rally. If you look at just what's happened in China, we had the height of the new cases on February 3rd. Since then, that market has rallied 12%. So here in the US, as we digest this news, it's important to remember that you can't necessarily wait till the all clear to look at opportunities, especially if you're a buyer.
Now, to your point, we obviously still don't know the full extent of how this could be contained, and especially when it comes to now different countries having different approaches to this. Do you feel the last 2 days have been almost a sign that this could be a slow burn? So similar to, let's say, what had been happening in the China trade war, and that until that phase 1 happened, we had seen markets move so dramatically based on headlines, and we saw little takebacks, right, little pullbacks every time we got one of these pieces of news, and ultimately, we're back up now over 400 points. Do you think this same pattern could be replicated here as the coronavirus stories continues to develop?
I definitely think that as headlines come out, it's going to move markets. But what we've observed on our desk is it's been fairly orderly. It hasn't been a lot of panic selling. And when I talk to my institutional desk, same kind of commentary. So the market had a great start to 2020. Maybe this is a little bit of a breather. This is normal. And again, we wait and see kind of how this is going to play through, because again, this is one of those unknown unknowns that we can't necessarily build a model around to understand.
Absolutely. And last year, for those who had been watching at that time, I kept asking everybody, what is the big unknown for next year? What is the thing we don't know, right, for next year? And this is one of those things. Exactly. Now, we are hearing, though, big events like the Olympics may be even at risk of being canceled. Conferences are being canceled, and some have said that we can make up for this demand later on in the year. Do you believe that to be true? We are losing time. You don't buy time back.
You don't buy time back, and certainly on the service side, so restaurants, movie theaters, theme parks, they're going to all be impacted in the short term, versus on the product side where you might just delay the purchase of a certain electronic till the third or fourth quarter. So I think it really depends on what sectors you're looking at here and being really thoughtful about where you're putting that incremental dollar, because there certainly be those that are more punished than others. Now, that being said, I do think that there are some sectors that are overly punished here, and that would be technology. It's down about 10% from the highs, and because it touches both the supply chain as well as the demand side, it has really taken majority of the hit. So I would be selectively looking at technology names, those names that have been on your shopping list, as well as semiconductors within the space.
Really quickly before we let you go, any expectation on how GDP may be impacted domestically and internationally here?
As we look through the US, based off of what we know today, minimal impact. Europe and Japan, probably about a 1% quarter over quarter growth impact. China's still going to be that larger hit, probably around 7% quarter over quarter.
All right, huge.
Yeah.
Thank you so much for being with us today.
All right, thank you.
Cayman Wills is the Global Head of Equities at JPMorgan Private Bank. Thanks again.
Thank you.